high interest rates continuing to squeeze households and investors, and the upcoming federal budget could bring major changes to the property market. Anthony Landahl from Equilibria Finance joining me now. So Anthony, how are you seeing borrowers and investors react to what we are hearing potentially could come through in the budget?
Yeah, investors are obviously quite wary, both existing investors and new investors. There's obviously talk of changes to the capital gains tax concession. I think that's going to happen. Momentum's built there. It's been on the radar for a long time, notwithstanding the government suggesting they wouldn't make any changes. That's evolved a little bit. They're either looking at lowering the concession or only taxing the real gains, so CPI adjusted, and then they're also looking at negative gearing changes, whether that's limited to 2 properties or in fact just to new builds. Whilst grandfathering will most likely prevail, it's really impacting a lot of new investor decision making, and I think it will slow the investor market, to be honest with you, just because of those changes. And essentially what the government's trying to do is open up more opportunities for owner-occupiers. The big risk there is that investor stock's already low, rental vacancies are in some capitals are below 1%, as well as the fact that it could also push up existing rentals because a lot of investors will pass those costs on. So I think there will be a slowdown in momentum for investors, not only with the interest rate rises and the cost of funds going up, but also some of these pending changes.
Yeah, it's interesting because I've had a lot of people say that it may also force or mean that we get in an environment where people don't ever want to sell because of those CGT changes. Would you see that sort of scenario, and then what does that mean for the rental market?
Yeah, that's an interesting comment. We've also had conversations with investors, some of who may buy, hold for a short term, and then sell. So we might see timeframes change with investors. It may impact first buyers who decide to rent vest rather than buy a home because they can't get into the market. One of the objectives of rent vesting is buy a property, sit on it for a couple of years, sell it, and then actually be able to use some of those gains to afford to buy an owner-occupier property. So it could also impact some first home buyers who use rent vesting as a way to get into the market.
So this week we also had a third rate hike. How is that impacting borrowers, investors? How can people sort of get on top of this if they're struggling, I guess?
Yeah, look, I think the first 2 rate hikes were reasonably well absorbed by borrowers. I think it's starting to bite now. The 75 basis points up to 4.35%, back at December 24 levels where it sat for about 12 months. In real numbers, on a $500,000 loan, it's about $240 a month now. On a $1 million loan, which seems like a lot, but not that unusual these days, you're looking at about an extra $500 a month. That is really impacting a lot of borrowers, particularly those who might have had the low deposit loans, borrowing 95% of the property. I guess the sort of guidance we're giving for homeowners is make sure you're utilising your offset account, because that can help with how much interest you're paying. Talk to your mortgage broker or your bank about, are you on the best rate? Some borrowers are looking at fixing. Whilst the fixed rates are a bit higher, it just gives them comfort around their repayments. And if you have paid more off your loan, you can in fact lower the limit, which will lower the payments. So with potentially another 1 or 2 rate rises, there are people feeling that squeeze. For investors, the cost of funds have gone up. Cost to hold a property, will that flow through to the rental market? Possibly. And obviously the cost to buy a property. So there's a lot more investor activity under the $1 million price point now.
I went to an auction on the weekend. There was only actually 3 registered bidders, even though it went for $250,000 above reserve. But the agent was saying it's very much a buyer's market. So we're expecting a further downturn in some of the capital cities in particular? Yeah,
the capitals are turning, Sydney and Melbourne particularly. The April numbers were the slowest growth of 0.3% nationally since January. It's very much a split market. The more affordable markets, under $1 million, and the regional markets are seeing strong growth. The less affordable markets are seeing slower growth, and we're seeing some prices really drop there. So from those perspectives, yes, it is a buyer's market, but it is still quite competitive amongst the first home buyers and investors under that $1 million mark. And I think that will remain, just for the sheer fact of chronic supply shortage that we don't really have a solution for.
And if there is a downturn, historically they don't last all that long, right?
They don't last that long. I think we will see a bit of a sustained slowdown in some of the higher quartile markets, just for sheer affordability. But I do see those under $1 million markets, if there is a bit of a downturn, not lasting for long. People will adjust, new buyers will adjust their borrowing capacity and what they can afford, investors will adjust to the market, and I think we will continue to see strong momentum, even if the rate of growth slows in the more affordable markets nationally.